If you came here to get better at covered calls, you came to the right video. Today, I'm going to be demonstrating the way I'm thinking about a current in the money covered call position that I have on e.l.f. Beauty. Now, you don't have to be doing this, of course, on just e.l.f. Beauty, what I'm trading. You can do this in whatever covered call that you're working on in your own portfolio. The purpose of this video is just for you to see in real time the way I'm trading, the way I'm thinking, and implement it in your own portfolio. Now that's what I find is the best way to teach this kind of stuff is just look at what I'm doing and look at how I'm thinking and then try to draw inspiration from that for your own portfolio and your own goals. Okay, without further ado, let's get into it. So we have right here an e.l.f. Beauty covered call at $90 strike. My cost basis is actually about 70 bucks. Waiting for this to load. Waiting for this to load. Where is it? Okay. 69.27. So that's my average cost. So rule number one, of course, with any covered call you do, is make sure that the strike price you set is well above the cost basis that you bought it at. It can be slightly above, but if it's a stock that you genuinely love to own, which is the core of this strategy, you got to be willing to at least, let it go at that price because you don't want the trade working against you and then having anxiety attacks all the time, so this is supposed to make your life better and easier. You don't want to be in conflict with yourself. Okay, so right now, my average cost 69.27. e.l.f. Beauty currently trades at 92, and when I sold this trade, it was actually way out of the money. It was like 75 dollar trading at 75 bucks, and then I sold a 90 call, so it gave a lot of room for upside. So this is actually an ideal situation. So at the time of recording this video, e.l.f. Beauty is, or my contract is expiring on the 21st of August. $90 call. So the contract value right now is 368. Now that value, that's basically if I were to close it today, I would have to pay $368 to close the contract and then release back my control of the shares. Now what that value comes from is because the stock is trading at 92.17 right now, there is $217 of intrinsic value for that contract. And then the rest is going to be time value and also a little bit of uncertainty priced in. So if everything stays equal and the contract just expires, right, up until August 21st, right, which is about 4 days from now. Now here it says simulated returns. Technically, it's a $61 return, right? But that number is actually not correct. Now it's 65 bucks. Basically, what that is if it were to expire, and then it kind of calculates the money like left on the table as a loss, because if you were to like close that contract at the time of expiration, right? That intrinsic value, you would have to pay that, and which it would be like technically a loss. But we're not doing that. We're actually, I got paid about 280 bucks at the time of making the trade. So my actual break even to like let the shares go would be 92.80, right? Which is why when it trades at it says a $65 profit, it's because the stock, if everything just stays the same, 92.16, my 92.80 minus the 16, that's where we get that simulated return. Anyway, so that's we're not going to pay to close the contract. We're going to either let it expire, which is a possibility, right? That's where I would get the shares back. Let's say I just want to sell the shares, get my 9K, and I, of course, keep my premium that I got originally. And all is good. I can move that money into another trade. That's one option. Now, the next thing to think about is possibly rolling the position, right? So what a roll is where you close the position today, you pay that price to close it. Right now it's 373, so that would be $373. And we would open a new position further out in time. Could be a week, could be a month, could be a year. And that, and then also raising the strike price. So Basically the point of that is to add time value to the contract and hopefully get a credit, right? So $90 call, let's just see. It would be $358 to close it right now, right this second, as the time of recording. Now we could set it for August 28th, which is 1 week after at the time of recording. And we can put it to 92 bucks, let's say. We would get a credit of like, I don't know, $17, $18. And we would raise the strike price by $2 to raise the contract 1 week. Or we can keep it the same. We were going to let it go at 90 bucks anyway. We'll get paid $483 minus what we paid to close the contract today. So that's about, 125 bucks, 130 bucks. So that's for 1 extra week. Got to pay 125 bucks and life could be good, right? Now let's look at actually extending this contract a little further. Let's go maybe September 18th, 32 days out. Now, I was already willing to let it go at 90. And if I just keep it the same, now there's a lot higher risk of the shares being called away at 90 than 95, which is why 90 pays more, right? So if we were to pay $358 today, we can get paid today $700. So that's about $350-ish, 342, I believe. That's to keep it at 90. So now the choice is, do I want to raise the strike to 95, which gives me more upside, right? I am bullish on e.l.f. And I would get a credit actually. So I would have to raise the contract a month, get paid about 110 bucks, raise to 95 strike. So that's actually pretty good. Now the risk there is the stock goes down. I'm holding the shares anyway. I keep the premium. So I made about 100 bucks. And the contract then expires later worthless. Or it blows past and it goes to, 100 bucks, 110, 150, I don't know. And then you're stuck kind of selling those shares at that price unless we then manage and roll again. So that's the options right now. At this moment, I'm actually just gonna wait about 4 more days. I think I'm gonna just take my chance in this 4 days, just see what happens. To manage it, usually if I'm on this kind of cusp right here, I sometimes just like to wait till closer to expiration. I'm looking at some other trades. I may roll this e.l.f. beauty position. Those are the options that I looked at. Well, I just went over with you. But there's another trade. If I were to let this go, if I were to let the shares go at 90 bucks and I release my 9K cash because it sold the shares, I'm looking at Netflix. Now, I like Netflix. I was thinking about this yesterday and watching Netflix, and sometimes I don't even watch Netflix. But Netflix is one of those things where even if I don't watch it for like a month or two, I'm not going to cancel it just because I stop watching for a month or two. I'm going to just keep using Netflix. It'll just stay on there. I'll still pay the subscription and it's always there. It's just kind of been this like household necessity. You just always have it, even if you don't use it, right? So the numbers are good. The PE ratio is good. We're not going to go over those numbers right now, but it seems like a pretty attractive price in the $70s region. Now, one of my main rules with selling any options contract is you have to understand the business. You have to like the stock and the company and be willing to just buy the shares at even this price, right? You have to be bullish on the stock. You don't want to own something that you don't even like. So I like Netflix. That's the first thing at this price, because you could definitely have the right stock at the wrong price. So this is a good price in my opinion. And yeah, it's the right price, in my opinion. Now, remember, I'm not a financial advisor. This video is just for education. So, yeah, back here, this was, it had quite a substantial fall, picked up a bit, and now we're back. So I think there's a lot of upside for Netflix. So we'll see what happens, but I'll be looking at if I get that cash. Um, if I look at, let's see, the 70, that's so conservative, the $70 strike for a cash secured put, and it would only pay about 1%. Now, I don't like to really chase premium, especially on like stocks I don't like, of course. I like the stock. But for 75 bucks, Netflix, I would honestly, I'm not just saying this, I would buy the shares just straight up, not for I would buy the shares at 75, right? Or 73, right? I would do that. Now this, you know, could go down 74, 73. We have delta about 0.32, but honestly, for Netflix, I may just I may sell an at the money cash secured put right around here, collect a juicy premium. But anywhere in this range, 75, 74, 73, that's what I would be looking at. I don't have the cash right now, so I'm not going to be looking too much into that. Just hoping that if I end up letting go of the shares, that's probably my next move. So something that helped me to not be so married to a certain stock is to just to have another trade lined up, have other stocks lined up that you're looking to do some trades on. Because otherwise, you can get so married to the stock that you're willing to roll at whatever cost, right? So that's something that just helped me a little more to not be so married to the stock. Now, I might not let this expire. I might end up rolling, but I'm going to give it a couple more days and I'll keep you guys updated with what I end up doing. Feel free to leave a comment on the video if you guys want more of a real time. You guys can ask me what I'm doing and I'll get back to you. So that's one way to contact. Yeah, pretty much it. Let me know if this video helped you to see my thought process on that trade, and we'll see you in the next video. Appreciate you watching.